Question 1. A life insurance policy owner in Washington stops paying premiums and allows the policy to lapse after several years. If the policy has accumulated cash value, which of the following non-forfeiture options provides the most life insurance coverage? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Automatic premium loan. Answer: C. Extended term insurance. Extended term insurance provides the highest amount of life insurance coverage because it uses the policy's cash value to purchase a single premium term policy for the same face amount as the original policy. While the duration of coverage is limited by the cash value, the death benefit itself remains the full face amount. This option is often the default if a policy owner does not choose another non-forfeiture option, ensuring continued protection for the insured for a period. Remember, this option extends coverage, not the accumulation of cash value. Question 2. Under a Washington life insurance policy, if the insured commits suicide within a specified period from the policy's issue date, what is the insurer generally obligated to pay? A. The full death benefit. B. Nothing, the policy is voided. C. A refund of premiums paid. D. The cash value accumulated, if any. Answer: C. A refund of premiums paid. The suicide clause in a life insurance policy, typically effective for 2 years in Washington and most states, stipulates that if the insured commits suicide within this initial period, the insurer will only refund the premiums paid, not the full death benefit. This clause is designed to protect insurers from individuals purchasing policies with the intent of committing suicide shortly thereafter. After the 2-year period, the full death benefit would typically be paid, even in the event of suicide, as the policy has passed the contestable period and the suicide clause's effectiveness. Question 3. An insurance producer in Washington is explaining the features of a new life insurance policy to a client. The producer must inform the client about the free look provision. How many days does a new life insurance policy typically have for the free look period in Washington? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. In Washington state, new individual life insurance policies typically come with a free look period of 10 days. This provision allows the policy owner to review the policy after delivery and, if not satisfied for any reason, return it to the insurer for a full refund of premiums paid. The 10-day period begins when the policy is delivered to the policy owner, not when it is issued, giving them ample time to ensure the policy meets their needs. It's an important consumer protection that ensures buyers are truly satisfied with their purchase. Question 4. All of the following are typically considered settlement options for a life insurance policy's death benefit, except A. Lump sum. B. Fixed period installments. C. Reduced paid-up option. D. Life income option. Answer: C. Reduced paid-up option. The reduced paid-up option is a non-forfeiture option, which means it is an election made by the policy owner when a policy with cash value is surrendered or allowed to lapse due to non-payment of premiums. It uses the existing cash value to purchase a new, fully paid-up policy for a reduced face amount. In contrast, lump sum, fixed period installments, and life income option are all methods for how the death benefit proceeds are distributed to the beneficiary after the insured's death. This distinction is crucial for understanding how a policy operates during its lifetime versus at the time of claim. Question 5. A life insurance policy owner wants to ensure that the policy's death benefit will always be paid to their surviving children, even if one of the children predeceases them, with that deceased child's share then passing to their own heirs. Which beneficiary designation should be used? A. Per capita. B. Revocable. C. Contingent. D. Per stirpes. Answer: D. Per stirpes. The per stirpes beneficiary designation ensures that if a named beneficiary dies before the insured, that beneficiary's share will be distributed to their heirs, usually their children, or by the root. This method provides for generational distribution, protecting the original intent of including a particular family line. In contrast, per capita would mean the deceased beneficiary's share would be divided among the remaining living beneficiaries, potentially cutting out the deceased beneficiary's descendants. Question 6. Which statement accurately describes the tax treatment of a life insurance policy's cash value growth in Washington? A. It is always taxable annually. B. It is taxable only when the policy is surrendered. C. It grows tax-deferred. D. It is never taxable. Answer: C. It grows tax-deferred. The cash value accumulation within a permanent life insurance policy, such as whole life or universal life, grows on a tax-deferred basis. This means that the policy owner does not pay taxes on the interest or investment gains as they accrue each year. Taxes are typically only due if the policy is surrendered for its cash value and the amount received exceeds the premiums paid, or if withdrawals are taken that exceed the basis, premiums paid. This tax-deferred growth is a significant advantage, allowing the cash value to compound more efficiently over time. Question 7. An applicant for a Washington life insurance policy intentionally fails to disclose a significant medical condition on their application form. This action is known as A. Warranty. B. Representation. C. Concealment. D. Adhesion. Answer: C. Concealment. Concealment refers to the intentional withholding of material facts by an applicant that are crucial to the insurer's decision to issue a policy or the terms of that policy. If the applicant knowingly hides information, such as a serious medical condition, it is considered concealment. This can lead to the policy being voided or claims being denied, as the insurer bases its underwriting decision on the information provided, and incomplete information distorts the risk assessment. Always ensure complete and accurate disclosure on insurance applications. Question 8. In Washington, an insurance producer must hold a separate license endorsement to sell which type of life insurance product? A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. Answer: C. Variable life insurance. To sell variable life insurance in Washington, an insurance producer must not only hold a state life insurance license but also a securities license, specifically, a FINRA Series 6 or 7. This is because variable life policies, unlike traditional whole or universal life policies, invest their cash values in separate accounts that are subject to market fluctuations and are regulated as securities. This dual licensing requirement protects consumers by ensuring producers are qualified to explain the investment risks involved. Question 9. Which of the following statements regarding the grace period for life insurance policies in Washington is most accurate? A. It is typically 10 days and is optional for insurers. B. It is typically 30 days, and the policy remains in force during this time. C. It is 60 days, and coverage automatically terminates at the end of the period. D. There is no grace period for life insurance policies in Washington. Answer: B. It is typically 30 days, and the policy remains in force during this time. In Washington and most states, a life insurance policy includes a mandatory grace period, which is typically 30 or 31 days. During this period, if the premium is not paid by the due date, the policy remains in force, and coverage continues. If the insured dies during the grace period, the death benefit will be paid, minus any unpaid premiums. This provision gives policy owners a short window to pay their premium without losing coverage. Question 10. A Washington life insurance policy contains a guaranteed insurability rider. This rider allows the policy owner to A. Increase the policy's face amount at specified future dates without proof of insurability. B. Receive a guaranteed interest rate on the policy's cash value. C. Convert the policy from term to whole life without medical examination. D. Waive premiums if the insured becomes disabled. Answer: A. Increase the policy's face amount at specified future dates without proof of insurability. A guaranteed insurability rider, GIR, is a valuable addition to a life insurance policy, granting the policy owner the right to purchase additional amounts of insurance coverage at predetermined intervals, example specific birthdays or life events like marriage or the birth of a child, without having to prove insurability. This means no medical exam or new underwriting is required, even if the insured's health has deteriorated. This rider is particularly beneficial for younger individuals who anticipate future needs for increased coverage. Question 11. An insured in Washington has a life insurance policy that allows them to skip premium payments as long as the policy's cash value is sufficient to cover the cost of insurance and expenses. This describes features common to which type of policy? A. Whole life. B. Term life. C. Universal life. D. Variable whole life. Answer: C. Universal life. Universal life insurance is characterized by its flexibility in premium payments and death benefits, as well as its transparent structure where the cash value accumulates based on current interest rates, less deductions for the cost of insurance and expenses. Policy owners can indeed skip premium payments, provided there is enough cash value to cover the policy's monthly deductions, making it highly adaptable to changing financial situations. This unique feature distinguishes it from traditional whole life, which requires fixed premiums. Question 12. If a Washington insurance producer replaces an existing life insurance policy, they are required to provide the applicant with a notice regarding replacement. What is the primary purpose of this notice? A. To guarantee the new policy will have lower premiums. B. To inform the applicant about potential disadvantages of replacing their policy. C. To verify the applicant's income for the new policy. D. To waive the free look period for the new policy. Answer: B. To inform the applicant about potential disadvantages of replacing their policy. The primary purpose of the notice regarding replacement in Washington, and generally in most states, is to protect consumers by clearly outlining the potential disadvantages and consequences of replacing an existing life insurance policy with a new one. These disadvantages can include loss of favorable policy provisions, new suicide and incontestability periods, higher premiums due to age, or new surrender charges. This notice ensures the applicant makes an informed decision, understanding that replacement is often not in their best interest. Question 13. Which of the following is considered an unfair trade practice in Washington when dealing with life insurance policies? A. Explaining the policy's terms and conditions truthfully. B. Offering a prospective client a portion of the producer's commission as an inducement to purchase a policy. C. Informing a client about all available riders on a policy. D. Providing comparative quotes from multiple insurers. Answer: B. Offering a prospective client a portion of the producer's commission as an inducement to purchase a policy. Offering a prospective client a portion of the producer's commission as an inducement to purchase a policy is known as rebating, which is an illegal and unfair trade practice in Washington and most other states. This practice creates unfair competition and can lead to discriminatory pricing among policyholders. Insurance transactions must be based on the policy's merits and standardized rates, not on special inducements or kickbacks. Question 14. An individual purchases an immediate annuity in Washington. When would they begin receiving payments? A. Payments begin after a specified accumulation period. B. Payments begin at a future date chosen by the annuitant. C. Payments begin within 1 year of purchase. D. Payments begin only upon the annuitant's death. Answer: C. Payments begin within 1 year of purchase. An immediate annuity is designed to begin providing income payments to the annuitant very soon after it is purchased, typically within 1 year, often as early as 1 month. This type of annuity is usually funded with a single lump sum payment and is chosen by individuals who are looking to convert a sum of money into a stream of guaranteed income right away. In contrast, a deferred annuity involves an accumulation period before payments begin. Question 15. The payer benefit rider in a juvenile life insurance policy in Washington provides that A. The policy will pay a lump sum if the payer dies. B. Premiums will be waived if the policy's payer becomes disabled or dies. C. The policy's cash value can be accessed by the payer without penalty. D. The policy will become paid up at age 18. Answer. B. Premiums will be waived if the policy's payer becomes disabled or dies. The payer benefit rider is specifically designed for juvenile life insurance policies. It states that if the individual responsible for paying the premiums, the payer, usually a parent or guardian, becomes totally disabled or dies before the insured child reaches a certain age, example 21 or 25, the premiums on the juvenile policy will be waived until the child reaches that age or the policy becomes paid up. This ensures the child's coverage continues even if the premium-paying adult is no longer able to do so. Question 16. In Washington, the Commissioner of the Office of the Insurance Commissioner, OIC, has the authority to do all of the following, except A. Issue a cease and desist order to an insurance producer. B. Enact new insurance laws for the state. C. Conduct examinations of insurers' books and records. D. Impose fines for violations of the insurance code. Answer. B. Enact new insurance laws for the state. While the Washington Insurance Commissioner has significant regulatory power, including issuing cease and desist orders, conducting examinations, and imposing fines, they do not have the authority to enact new insurance laws. The power to create and pass laws rests solely with the state legislature. The Commissioner's role is to enforce the existing laws and regulations, issue rules and bulletins that interpret those laws, and ensure the insurance industry operates fairly and in the public interest. Question 17. Which of the following is not a standard dividend option for a participating life insurance policy? A. Cash payment. B. Reduced premium payment. C. Extended term insurance. D. Accumulation at interest. Answer. C. Extended term insurance. Extended term insurance is a non-forfeiture option, not a dividend option. When a participating life insurance policy pays dividends, the policy owner has several choices for how to receive or use those dividends, such as taking them as cash, using them to reduce future premiums, letting them accumulate at interest, or using them to purchase paid-up additions. Extended term insurance, however, is an option available when a policy's cash value is used to provide temporary coverage if the policy lapses due to non-payment of premiums. Question 18. An insurance producer in Washington takes client premium payments and deposits them into their personal bank account, intending to forward them to the insurer later. This action is considered A. Rebating. B. Twisting. C. Commingling. D. Defamation. Answer. C. Commingling. Commingling is the illegal practice of mixing a client's funds with a producer's personal funds. Premium payments collected by a producer on behalf of an insurer are considered trust funds and must be kept separate from the producer's personal or business accounts. This practice violates the producer's fiduciary duty and can lead to serious disciplinary action, including license suspension or revocation. Proper handling of client funds is a cornerstone of ethical insurance practice. Question 19. An insured in Washington has a variable life insurance policy. Which statement about the death benefit of this policy is true? A. It is guaranteed to remain level for the life of the policy. B. It fluctuates based on the performance of the separate account, with a guaranteed minimum. C. It is determined solely by the current interest rates. D. it can only increase, never decrease. Answer: B. It fluctuates based on the performance of the separate account, with a guaranteed minimum. Variable life insurance policies are unique because their cash value and, potentially, their death benefit fluctuate based on the investment performance of a separate account, which is typically invested in stocks, bonds, or money market funds. While the cash value is not guaranteed, these policies usually offer a guaranteed minimum death benefit to ensure a basic level of protection, regardless of poor investment performance. This makes them distinct from traditional whole life policies where the death benefit is usually fixed. Question 20. An applicant for a life insurance policy in Washington has made a material misrepresentation on their application. Under what circumstances can the insurer typically rescind the policy or deny a claim based on this misrepresentation? A. At any time, regardless of when the misrepresentation was discovered. B. Only if the misrepresentation was discovered within the contestability period. C. Only if the misrepresentation was intentional and material, and within the contestability period. D. Only if the insured dies within the first year of the policy. Answer: C. Only if the misrepresentation was intentional and material, and within the contestability period. An insurer can typically rescind a life insurance policy or deny a claim based on a material misrepresentation only if the misrepresentation was both intentional, fraudulent, and material, and the discovery occurs within the policy's contestability period, which is typically 2 years from the issue date in Washington. After this period, the policy becomes incontestable, meaning the insurer generally cannot deny a claim due to misrepresentations made on the application, even if they were material, unless it pertains to an intentional misstatement of age or sex or fraud. Question 21. All of the following are typically considered primary sources of underwriting information for a life insurance application, except A. The application itself. B. The Medical Information Bureau, MIB, report. C. Consumer credit reports. D. The producer's personal opinion of the applicant. Answer: D. The producer's personal opinion of the applicant. While a producer's observation of an applicant's general health or lifestyle might be noted in the producer's report, it is not a primary source of objective underwriting information used to assess risk. Underwriters rely on factual, verifiable data such as the application form, medical examination reports, if required, the Medical Information Bureau (MIB) report, which shares coded health information among member insurers, and potentially consumer credit reports or motor vehicle reports to accurately assess risk. Question 22. In Washington, if an insured names their spouse as the irrevocable beneficiary on their life insurance policy, what does this mean? A. The beneficiary can be changed at any time by the policy owner. B. The policy owner needs the beneficiary's written consent to make any changes to the policy that would affect the beneficiary's rights. C. The beneficiary receives the death benefit only if they survive the insured by a specific period. D. The policy will automatically transfer ownership to the beneficiary upon the insured's death. Answer: B. The policy owner needs the beneficiary's written consent to make any changes to the policy that would affect the beneficiary's rights. Naming an irrevocable beneficiary means that the policy owner cannot make any changes to the policy that would affect the beneficiary's interest without the written consent of that named beneficiary. This includes changing the beneficiary designation, surrendering the policy, taking out a loan against the cash value, or assigning policy ownership. This designation offers a higher level of protection to the beneficiary, ensuring their right to the death benefit is secured. Question 23. A life insurance policy in Washington includes an accidental death benefit (ADB) rider. If the insured dies in an accident, what will the beneficiary receive? A. Only the face amount of the policy. B. The face amount of the policy, plus the cash value. C. The face amount of the policy, plus an additional benefit equal to the face amount, double indemnity. D. Only the additional benefit from the rider. Answer: C. The face amount of the policy, plus an additional benefit equal to the face amount, double indemnity. An accidental death benefit, ADB, rider, often called double indemnity, is a rider added to a life insurance policy that pays an additional death benefit if the insured's death is directly caused by an accident, as defined in the policy. Typically, this additional benefit is equal to the policy's face amount, meaning the total payout would be double the original face amount. This rider provides extra protection for unexpected, accidental fatalities, but it does not apply to deaths from natural causes or specified exclusions. Question 24. What is the main characteristic that distinguishes a qualified retirement plan from a non-qualified retirement plan in terms of taxation in Washington? A. Qualified plans allow for tax-free withdrawals in retirement. B. Contributions to qualified plans are tax-deductible for the employer and not immediately taxable to the employee. C. Non-qualified plans offer unlimited contribution amounts. D. Qualified plans are not subject to ERISA regulations. Answer: B. Contributions to qualified plans are tax-deductible for the employer and not immediately taxable to the employee. The primary distinction between qualified and non-qualified retirement plans lies in their tax treatment and regulatory oversight. Contributions made to qualified plans, like 401(k), S or HR 10 plans, are typically tax-deductible for the employer and are not immediately taxable to the employee, allowing for tax-deferred growth. These plans also adhere to strict ERISA, Employee Retirement Income Security Act, requirements regarding participation, vesting, and funding. Non-qualified plans do not receive the same favorable tax treatment but offer more flexibility in terms of who can participate and contribution limits. Question 25. A life insurance producer in Washington is completing an application with an applicant. The producer asks the applicant for their height and weight. If the applicant intentionally provides incorrect measurements to qualify for a better rate, this is an example of A. Twisting. B. Misrepresentation. C. Defamation. D. Churning. Answer: B. Misrepresentation. Misrepresentation occurs when a person, in this case, the applicant, makes a false statement of a material fact on an insurance application with the intent to deceive. Providing intentionally incorrect height and weight measurements to secure a lower premium falls directly under this definition, as these factors are material to the insurer's underwriting decision. This can lead to the policy being voided or a claim being denied if discovered within the contestability period. Always emphasize the importance of truthful answers on applications.